Okay, hi guys. Good afternoon or good morning, depending on where you are. Welcome to the FX Street webinar. My name's Ian Coleman. I'm one of the traders and analysts at firstofTrading.com. We produce technical analysis and trade calls on 13 FX products, stock indices, commodities, and fixed income. Basically, every month we join FX Street and we give a long-term view of in particular the FX majors. It's on a vanilla basis, or what I call vanilla charts. So we're just looking purely at price action. You might have noticed before I'd actually highlighted the wrong screen, and they're basically my trading screens. So the parts that I overlay on top of my analysis to get my triggers. So if you want to have a look at those later, then I'm more than happy to share. So FX majors. Now, obviously, the main part of 6 of the FX majors is the dollar or the dollar index. So I do have a very large emphasis on this in all my currency reports first thing in the morning. I'm then obviously very aware, i.e. today, of when there's an announcement due, whether or not it's Bank of England, what's come out overnight maybe from the RBA, ECB, etc., etc., etc. And then we look at other currency pairs or single currencies, if you like, for domination and correlation. Obviously, euro sterling, we might have a dollar bullish bias at the moment, but we've obviously got a bearish bias in euro sterling, and that can obviously influence our trade calls. So what we're going to do today is, like I said, we're just going to use purely vanilla charts. If you then, after we've talked about what I believe is going to be the sort of medium-term picture for the currency pairs, then we can flip it on its head a little bit, and we can have a look at some of my trigger charts, if you like, or we can look at some stock indices or whatever you guys would like to do. Please do try and interact as much as possible. I want to make sure that everybody understands what I'm saying. No question is a stupid question. If you don't understand, or if I've lost you at any point, then please let me know. So, like I said, we're going to look at vanilla charts to start with. I do have other things that I look on my, if you like, my trigger charts. I look at everything from a weekly chart or even a monthly chart at the end of the month down to weeklies, dailies, 4 hourlies. I then go to hourlies, 30 minutes, 10 minutes, 5 minutes, 3 minutes, and 1 minute. And depending on where my view is, depending on where my trigger is, will depend on my trade size, my money management, and obviously my profit targets. What I'm always trying to do is I'm always trying to trade with my view, but if my grey box system, and it is a grey box system, not a black box system, if my grey box system gives me a trigger, like a buy trigger, and I'm bearish in euro dollar, I will still take it. I just won't take it in the sort of size that I'd normally hit the trigger in. Basically, because I've found that even though the technical analysis side is, or I believe my technical analysis skills are pretty good, my system is probably slightly better. So, first of all, we're going to talk about the dollar index. Now, we can see here, obviously, I am 90% technical, okay, but I obviously know what's going on, the fundamental side of currencies and economies, etc. Obviously, everybody was waiting for Yellen yesterday. It was a bit of an anticlimax. We were bullish on the dollar after, well, basically looking to dip by the dollar, so looking to sell into rallies in euro, dollar and cable. And we're going to explain why we came to that conclusion and how you can then trade your bias. Okay. We don't always pick tops and bottoms, or very rarely. We do have a trend following system, but we're also aware of when the trend is, well, when we believe the trend is coming to an end. So the dollar index, now obviously this is the weekly chart, which was denoted there. Okay, decent sell-off. For the last over 2 weeks, actually 2 weeks and 3 days now, we've been stuck within this range. Okay, so we are channeling, if you like. There's no clear direction. One thing I should say is, obviously, when you look at vanilla charts, and sometimes these are actually Saxo Trader 2 charts, which are fantastic charts to use. I use these as my vanilla charts. Okay, so I have nothing on them, and I just use them for price action. I then have another chart package, which I have all my indicators on. And I think sometimes it's quite good to have a vanilla chart. You know, even if you've just got one that you keep on flicking to and just put, you know, euro dollar cable up or whatever, it's good sometimes just to see a clear picture. And what I basically want to do, I want to see fib levels. I want to see previous areas of support and resistance. I want to see price action, and price action to me is really aggressive reversal candles. Okay. And aggressive reversal candles are outside bars. Indecision candles are inside bars. So when I say an outside bar, I'm not talking about a bearish or bullish engulfing candle. I'm actually talking about a candle that completely takes out the previous candle. So here, going back to, 17th of June, okay, this is an aggressive outside bar. In other words, the market was still, when this bar opened, the market was still trending lower, and we did make a lower low, okay? But the sentiment, which is what we're trading, the sentiment reversed, and the bulls took control and completely took out this previous candle. So that's a bullish outside bar. We move higher, we then get a bearish outside bar. Obviously very hard. If you'd bought there and sold there, you would have probably about netted out, okay? One thing we should also say is these candles are relevant in every time frame. It's just the higher the time frame, the more relevant they are in the overall picture. Okay, so then we obviously move lower, and then we've been chopping around. We've got an outside bar here. This area is obviously now support, and this is what I'm talking about, support and resistance. If we move back, we can see support here. Okay, we then spike through a couple of times. Okay, and then it becomes support from this candle here on the 20th of Jan. So even though this is a bearish outside bar, we've rejected the previous high, okay, and we're not breaking lows, okay, so we've still got, we can place a trend line on the bottom here, and I'd really need to see a break of that lower trend to turn the index bearish once more. At the moment, buying dips is my play. This looks to me like an ascending triangle formation. So we've got this resistance level 81.53. Okay, we've then got higher lows. Okay, which is pushing this index to the upside. A break, my first target level is going to be just over 82. The figure is actually 82.01, which is an ABCD formation. So to get an ABCD formation, we basically take the low. So we want one of these little guys here. Okay, so we take the low to the high, we then move it across to the next swing low, okay, and it gives us our target level. Now that is not only an ABCD formation, but it's also a 50% pullback level of this last move. So we look for areas, or we like to see areas where there's confluence, okay, where things line up. And we're going to talk about sterling yen actually in a minute, because we're quickly moving towards a Fibonacci confluence area that could produce some decent reward to the downside if we get a rejection coming into today. So that's our target area. in the medium term. But then we're obviously not, as we said, we're not trading off weekly charts. We're trading off shorter time frame charts. I personally would never place a stop of 200 to 300 pips. I'm a day trader. If I was a swing trader or if I was a part-time trader, then yes, because I wouldn't have time to sit in front of screens all day. But that is my job. So, I'm looking to minimise my risk and maximise my reward. One thing I should say as well is we like to try and bleed trades. And by that I mean we like to try and get in with a minimum amount of risk exposure, maybe 10, 20 ticks. We then like to get some of the profit off, normally between 60 and 70%. And then if the outlook, if our bias is still in that direction, then we try and bleed a currency pair. So in other words, we leave a balance on, maybe even add on to it at certain levels or bouncings. But anyway, getting back to the dollar index, so we've got a bullish bias, and then really this was actually something that we posted on. I have been posting on Saxo Trading Floor, where we contribute quite a lot this week. And this again is a confluence area. So we've had this dollar index 4 hour. We've had a decent move up. If you were a mad Elliott wave enthusiast, which I'm not, you could probably argue this is 5 waves. 1, 2, 3, 4, 5. Okay, and then a move to the downside. What I have got is what I think is a bit of a disjointed bullish Gartley formation. So we've got 78.6% pullback, which makes the right wing of a good bullish Gartley, if you like, and then a 161 point. So that's 78.6 of the whole move higher. Let's just get our annotation, our little pen. Okay, so whole move higher, that's 78.6, and then this move lower, okay, is 161.8%, and that's what we want to see. We want to see that area. We want to see that area of confluence. Okay, didn't quite get there. What we did have, which you probably saw on my charts a little bit earlier, which I'm going to try and show you now. This is the dollar index. This is Aspen charts, and these numbers, which we talked about before. Okay, so I'm looking at the same thing, but it's more complicated. Okay, I've got trend of higher lows here. I hope you can still see that. If you can't, can somebody shout out? And then if I move over the time frames, okay, what we've got here is a 13. Now, DMARC, which is what these are, it's a DMARC exhaustion indicator, or DMARC sequential is actually called. Okay, so 78.6 or 80.48 was the area we're looking for. 13 counts normally dictate that we've come to the end of the trend. It actually saved us a few pips yesterday, because we would have normally gone in on that bullish engulfing candle there. But because it was only a 12 count, we did bide our time, wait till a 13 count had been produced, and then moved higher. And it's given us that dollar bias again this morning. So let's just move this on the way again. Okay, drop that down. I assume you could all see, because nobody's expressed anything differently. So the bias is to the upside. So where do we go to? How much of a bullish bias do we have in the dollar? Well, we've still got that weekly medium-term bias to move towards 82, the figure. Okay, so we've got 120 pips to go in the dollar index. But where's the target level for this pattern? So basically we want to drop these off, or drop that one off, okay? And then we want to re-highlight 50% and 38.2. Why do we highlight 38.2? Well, because it's 61.8% obviously in reverse, okay? And the target levels, for a minimum target level, I should say, for a bullish Gartley formation are 50 and 61.8% of the whole sequence, okay, which is allocated here. So we've hit the minimum. I'm sure we're going to hit the 80, 97. But intraday, okay, I'd be wary to still be buying dollars over 80.97. What I'd prefer to see is a dip down then before the next move higher. So just to reiterate what we've talked about with regards to the dollar index, we've got a short-term bullish bias. We look for a small correction and then a medium-term bias up towards that 82, the figure. What happens when we get to 82, the figure? Depends how quickly we've got there. Depends what the price action is when we get there, if we get there. Obviously, a break of 81.50, and we could see a very quick catapult as stocks are taken out and we move to the upside. Any questions about dollar index? Or I think probably next time we'll do a whole webinar on DMARC and explain how it can not influence, but how it can be used as a good overlay on your sort of day-to-day charts for trading. Okay, if there's no questions, we'll go to euro dollar. Start at the top, if you like, and move our way down. No? Okay. I did say at the start it'd be great if we could have some sort of participation. Or one person's posted a question, or anyway. Big picture. So we talk about big picture analysis, okay, depending on whether you're a day trader, you're a swing trader, etc., etc., etc. We also got a trend of high lows there. This is the weekly chart. So we're looking, again, you're always looking for things that line up, if you like an area where different parts of technical analysis line up. So we've got the 61.8%. We can see these wave formations, these moves higher and choppy, and three waves, or this one in particular, the AB leg, okay, and then to 61.8%. So giving that currency pair, or this currency pair, I should say, a bearish bias. But you can see on the weekly chart, I think this is quite important to note, especially for sort of day traders and intraday traders, how choppy this has been. Okay, we have moved lower, but look, I mean, bearish, bullish, bearish, bullish, bearish, bullish, and probably going to get a bearish week this week. So the medium-term picture has been mixed. There is a mild trend to the downside. You can't say that is a sell-off. I mean, that is very hard, not only to analyse, but extremely hard to trade. Okay, because we've got that dollar index that is failing to break out, but we've got that bullish bias. So dollar index, put it in the back of our head, we've got a bullish bias. Why should that be automatically reflected to the euro dollar? Well, mainly because the euro part of the basket, of the dollar index basket, is the main part of the dollar index basket. Okay, so if the dollar index is going to influence any currency pair, it should be influencing the euro dollar, the greatest, if you like. So again, breaking it down through time frames and just vanilla charts. Yesterday, what did we have? You see, this looks at the moment, this looks corrective because we have 1, 2, 3 up, then probably 1, 2, 3 down. Okay. Remember the dollar index, okay, 82.01, 150 ticks away. Okay, before we're going to hit some resistance in the dollar index. So thinking about that, bias for euro dollar to the downside before we hit some support. So can we get anything off this very choppy sort of daily chart? We can always get something. Just depends what we choose to see. So first thing we want to do is we want to put our fib retracement tool on. Okay, could have quite easily got spoofed, or it was a decent move up. Were there any reversal candles on the daily? No, but this strong move up on the 23rd of January definitely sort of put the cat amongst the pigeons and flung the bias back to the upside, especially the intraday bias calls. So what we want to do is we want to get through the ones, or get rid of the ones that have been taken out, if you like. And that is obviously 23, 38.2 and the 50% level. Thinking about the ABCD formation on the dollar index. Okay, so we go AB, so this is your swing high, swing low, and then take it away, and then move it over. Okay. 88.6, 133.62 is close. That is actually, talking about symmetrical patterns, that is a bullish bat formation. And again, I'm not too particularly bothered about what they're called. What I'm bothered about is where the target level is, what the risk is, and does it line up with something else. So we've got an ABCD formation, it lines up with 88.6%. But again, we've had this sort of decent move to the upside here. So I don't ignore these wave patterns. Just because we've got an AB here doesn't necessarily mean we're going to get an AB here. We can have shorter inside waves. My preferred count would be ABC, okay, the move up in corrective wave BC, and then ABC, okay. So this is my preferred target, and the 78.6% would actually work better for me visually, and I think it'll probably line up better with that dollar index. So this area here, okay, sort of between 134.22 and 130, just let me click over it, 133.52 would be the downside area we're looking for in the medium term. Okay, so now we want to flip this down to the dailies. So not to the dailies, to the hourlies, etc. Sounds like somebody's burning something next door. Okay, we shorted. I'm about to say that now. We shorted euro dollar at 136.50 this morning. Got out at 136. Again, breaking these down into waves again. Sugar extensions. It's not going to work. Sometimes you have to break it down, by the way, in shorter time frames to actually see where the waves start. Because if you had this on a 4 hour, digressing a little bit. No, it's not, it doesn't work on this one. But sometimes if you've got a big candle and it's spiked in both directions, you can't tell if it got to the high before it got to the low, if you see what I'm saying. Because if you're looking at wave counts, then it's very important to know whether or not we reach this level first or we dip to that level, on a higher time frame. Probably confusing everybody here, but it's just worth just breaking down, even if you can't, even if it looks like a line chart, just so that you can see which level got attacked first, okay? And again, we noted this both in our reports this morning and on Saxo trading floor yesterday, actually. We've had a 261.8% level. So we've had that move to the upside. We've now had dollar buying, okay? I would not look to buy into this. What I'd now be looking to do is to sell, okay? And I'm going to flip this around again. You've got to remember, what we talked about was the fact that we're in a corrective sequence, okay? Everyone gets quite hell-bent on, well, you've got 261.8% extension level, which we just had on the hourlies. So the next sequence is surely a pullback, in a three-wave pullback. So if we use the fib, so, 50, 61.8%, surely I should be looking to buy in around here. That's not a bad level to buy into. Okay, the 61.8% because it's 135.55. Okay, it was an area of resistance, become an area of support. At the moment, it's still an area of support. But I think even if you get down to that level, you probably see a little bounce up from some sort of head and shoulders. Okay, and then the move down. What I was saying before was, don't get too don't get your mindset too fixated with, I've had a 261.8% move to the upside. I've now got to see a corrective sequence, because at some point it's got to flip to start with. If you're in a corrective sequence anyway, then the waves inside the waves, if you like, can be 5 waves, 3 waves. They can extend to 261.8%. They can come down to just 161.8%. They concentrate more on the fibs, concentrate more on the Fibonacci levels, concentrate more on the confluence areas. Okay, the confluence areas are, as I was saying, here, at the moment. It's the bias is still to the downside. Like I said, dollar index just hit the minimum requirement. So I think what we'll probably see in the dollar index now is just a mild dip before the next move to the upside. I'm just going to show you this. So we'll go back to my other sheets. And this is where it can work quite well, okay? But it works well anyway, but try not to overlay too much on top. Okay, so going back to, what should we look at? We're looking at Euro dollar. Okay, remember 9 and 13 counts. Okay, so we don't want to be selling into 9 and 13s because DMARC basically says that 9 and 13s are where you reverse or you correct. Okay, so here's a 13 count. I know it's hard to see. That was that move to the upside. Here's a 13 count, did nothing. Okay, so it's like everything else. It's good as an overlay. It's good when it lines up with something else. But don't just trade it because it's, as a standalone instrument, it's not fantastic. Here, the hourly. So that was the 261.8% up we talked about. What do we get off the top of 13? Okay, now we break it down into shorter time frames. This is the hourly. 9 count is just a correction. Okay, this is the hourly. Is there any reason why I should be buying it? No. Let's open it up again. So I don't need. I've got that many screens. It's hard to overlay on top all the time. Okay, and then we go down to short time frame. Now, this is what I was saying about, do I want to sell it at current levels? No, I don't. Why don't I want to sell it at current levels? Why? Because first of all, it's oversold in this time frame, in this time frame, in this time frame. And also, I've got these 9 counts. They're now 9 counts, and we've got these shorter time frames. I'll move it across. Okay, 9 counts have a tendency to, in every time frame, have a tendency to highlight at least a correction. Okay, maybe not a trend reversal, but at least a correction. So even though the immediate bias is for lower levels, I would look for a correction higher from current levels, okay, to sell into. Any questions? I've made myself sort of understood. I don't like that. Sometimes I've got so much information that sort of, you're with the glasses. What's that mean? You're with the glasses. I've got glasses on today. Oh, right, okay. That's correct. You're not supposed to be able to see that background. That was a Christmas party. Yes, it's I'm with the glasses and the moustache. Okay. Cable. We talk about, a lot of time people talk about technical analysis being what one person sees against what somebody else sees, and it's true, because if we all saw the same thing, then, you know, we'd all be clambering to trade in one direction, and obviously we're not. And Fibonacci is very subject to that, if you like. I think this is a good example. Where did you take your first swing from? So this is obviously a new low here. That was 148.30. This was 148.16. So this was the low. So we have to take the swing low from here. So do I take it from this level? And this lines up nicely, if you like. We're going to free wave correction, and it gives cable a bullish bias all the way up to 71.82. Or was I take it down to the dailies? And then I say it's off that level, and we got a nice reaction here at 261.8%, and this is a fifth wave extension, etc. So it's very technical analysis. Can sometimes it gets a bad press, if you like, because it is subject to an analytical interpretation, if you like. You just need to make sure that your interpretation is better than the man behind you, I suppose. What we've talked about before as well is previous areas of support and resistance. Okay, so we're not just looking at fibs. We're not just looking at reversal candle formations. What we should also mention quickly is those engulfing candles. Okay, those outside candles. Prime level. If the stop is too big, a prime level to look at is the Marabuzo. And the Marabuzo level is 50% from the open and the close. So basically, you can hover over a candle like this one. You take the open, which is in the, let's move this up actually. Okay, so you take the open at 166.34. You take the close at 164.76. You'd add those two together and then divide by 2, and it will give you obviously the middle point. Okay. Obviously, we're looking at a daily chart. You know, if you just blindly sold off the back of that engulfing candle at the top, if you've got big enough pockets, fair enough. If you haven't, then the Marabuzo, are looking to get in around that Marabuzo level is always a nice option. I'm just going to use the crosshairs here just to show the example. So there was the Marabuzo level. Okay. Boom, 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 boom. I saw another one a minute ago. Must be going mad or blind. And support and resistance. Okay, so what I have a tendency to do, and again in different time frames, because different time frames can show different areas of support and resistance. Yes, open plus close divided by 2. I will get a horizontal line, and I will place it not at the high or the low, but I'll place it where the sort of candles finish, if you like. Okay. and I'll make notes of those. Because they show me that price was rejected above that area, okay? And you can see today, okay, price rejected above that area. I'm actually short around about here. I'm out of virtually all my morning trades. Like I said, I sold euro dollar, bought some dollar Swiss, bought a bit of dollar yen. I got stopped on that, but for 8 ticks, so I'm not particularly bothered about that. I'm holding on to this one because I do think we're gonna see lower levels in cable. So, and as you break it down through time frames, okay, these levels, these spike levels, if you like, do become relevant. I'm not saying have millions of lines all over your chart, okay, but you want to look for areas where we saw spike throughs. Okay, so support and resistance, even if it has gone through it, as long as it's rejected it and come back in, then they normally will act again as support and resistance levels. Now, the reason why I'm short of cable today is because of the dollar bias. Also, using correlation. I think euro sterling is probably overdone. Again, using correlation, sterling yen is very near a reversal area, I think. I've got resistance, previous resistance here, okay, 165.50. And also, going back to my DMARC, using my DMARC, I've got some exhaustion counts on short time frames. So, again, I'm trying to line up as much as I can to give me a bias for my trade. And a Fibo as well we've got on here. It's not a great one. We're in between 61.8% and 78.6%. If we break this down into short time frames, this was 261.8%, so we've broken past that. What was I going to say about cable? Not a great deal, really. I think this is the count. Going back to the Fibos, I think this is 261.8%. I think we've had a fifth wave extension because I can see it in 3 waves. I'm now looking for at least 3 waves to the downside. I haven't really got much of a head and shoulders. I mean, we can say it's slightly bent. We can say this is the left shoulder, right shoulder, neckline. Okay, this is left shoulder, right shoulder, but it's all a little bit skewed. Okay, what we can see is if we can close on the daily below 165.07, then the majority of technical analysts tomorrow will say that in their morning reports, they'll say cable posted the 5th positive day in succession and the 5th higher and higher low. However, levels close to 165.50 were sold into, and the pair closed below the 61.8% pullback level of 165.07. That's why technical analysis is so subjective, and sometimes we do need other influences to get us going. So just going to go on to sterling yen. Okay, this is what I was talking about with regards to a confluence area. Okay, what's the time? 22. Decent move to the downside. Okay, Elliott wave enthusiasts have been blown apart because if they said this was wave 1, this was wave 2, this was wave 3, By the way, that was perfect for a 61.8% pullback. So initially my thoughts were that it was a slight correction and then a move to the downside, especially with how aggressive stocks were being. However, that hasn't happened. We actually bought dips, or tried to buy dips this morning with this area, okay? So just breaking it down again to time frames. So decent risk reward again. If it's 61.8% pullback and the bias is still to the downside, then my risk reward is going to be ample because I'm going to be looking for new lows. If it's a 261.8% extension, and again, my risk reward is going to be decent because I'm going to be looking for at least around here, 167.58. So when we get these confluent areas, it's worth having a look at shorter time frames, try and get reversal candles, at least try and get lower lows, lower highs. And obviously myself, I look for all those things. I'll be looking for demark, I'll be looking for price action, I'll be looking for exhaustion, I'll be looking for the fact that it might be oversold in a certain time frame. But what I really want to see is those reversal candles. Okay, I want to see something that tries to get higher and falters and then gets us aggressively sold off to the downside, and then we get those outside bars. So short term, as I said, I'm short of cable, so you know my view on cable short term. I'm going to be looking probably to get out of this first batch around 164 the figure. I'll then review price action around there. Dollar Swiss. Now, dollar Swiss is one of my favourite currency pairs. And it's weird that I should say that really because of the fact that Euro Swiss very rarely goes anywhere. Dollar Swiss has a tendency to do exactly the reverse, or -1 correlated to euro dollar. So surely if you've got a good track record in dollar Swiss, you should really have a decent track record in euro dollar. But because I'm always analysing the dollar index, and this dollar Swiss, because obviously if I'm buying dollars, I'll be buying dollar Swiss, has a tendency to move in the same direction. I don't know why. Maybe it's the fact of that and the fact that I can sort of more easily reflect it onto the dollar index, onto the dollar Swiss, that I seem to have a slightly better track record for this pair. Anyway, monthly ABCD formation completed. 88.61 was a 38.2% pullback from that move from 2011 to 2012. It's an ABCD completed, like I said, so the bias is to the upside. Going back to shorter time frames, which we're able to do. I should have done it on this. In fact, I'm going to flip that back to here. Shorter time frames, we're in sort of a bit of a screwy triangle formation or consolidation. But then if you break it down to 4 hours, I'm not going to spend too much time on this pair. My iPad. We've got the same as the dollar index basically. Okay, so 161.8% was here. That was that move there. Got 78.6%. Like I said, our target or initial target level was around about 90 the figure in dollar Swiss, but I think we get much higher, and we've now completed. If you look here, this is the 38.2 or the 61.8% of the whole formation. So we've now completed the minimum requirement. But if you're a believer in any wave again, then you could say 1, 2, 3, 4, 5, 1, 2, 3. We're now in third wave higher. So any dips really should be bought into. And again, just using a vanilla chart and no overlays at all, you can quite easily see areas of support, okay, which line up with the fibs. So this is an area that was spiked through. If you look back here, again, it's another area of support. So, a move down to there, and it's going to offer a decent bit of risk reward. So I think we're going to see a minimum in the next few days of sort of 90, 80 and probably well above. We can break time frames. I'm mad about time frames because what one time frame tells you, another may not. Okay, it might be reversed, and then you want to decide, well, if that is the case, where's my big picture? Where do I really want to be? Do I think that we're going higher? If so, I'll ignore that bearish count in 10, 15 minutes, and I'll wait until it gets down towards one of my sort of support levels. Let's go to the hourly. And again, this is where you've got to have a bit of conviction, because this yesterday, around here, this was Yellen and everything else that was going on. You've got to have a bit of conviction in your own analysis. That is my Gartley pattern. If it breaks below 89.40, then I'll start to worry and pull in a stop. If it doesn't break below 89.40, then my pattern still holds. I've got an outside bar here. It didn't get broken to the downside. If you really overemphasize things too much or overanalyze things too much, you'd say that was a morning star formation. Okay, it's supposed to be an evening star formation. It's supposed to be at the top of the trend, but it's still a continuation pattern in the downtrend. Little waffling again. Again, just look to where the fibs are. Am I going to get a pullback? If I do get a pullback, 127% is a fantastic fib as well. And I think a lot of people ignore the inside fibs. 127, 161.8, 261.8, and then 423.6 I look for extensions, retracement fibs. Let's put it out anyway. Okay, then I've got 88.6, 78.6, because they make the symmetrical patterns. Okay, then I've got the Bob Basic, 23.6, 38.2, 50, and 61.8. It's nice my wife's just brought me a cup of coffee. So again, a pullback towards a fib level, and we can put lines on charts and just see whether or not, it was an area of previous support and resistance. And if it is, then we know that we've got a confluence area, and it would be a good sort of level to start fading and move to the upside. Okay, just been told by, I think it's Vicky, that we've got to wrap it up. Appreciate you guys coming along to listen to us. I will try my hardest, I'm saying this to Vicky, not to miss my next appointment or my next registered webinar at FX Street. Thank you for letting us continue to participate on the website, and I wish you guys all the best of luck with your trading in the near future. Okay, and hope to see you next time round. Okay, take care, and I'll speak to you again soon, I hope.